Okay, so something is happening in the silver market right now that honestly most people aren't paying attention to. And I want to talk about it because I think it matters a lot more than people realize. We're not just talking about silver going up or down for a week. We're talking about something much bigger, a shift that could genuinely affect your wealth over the next few years. So stick with me here because this is going to connect a lot of dots. Let me start with where silver is right now. Because here's the thing, silver has had an absolutely insane run. If you zoom way out, like on a quarterly chart going all the way back to the 1980s, what you see is genuinely remarkable. We're talking about 7 positive quarters in a row. Well, almost in a row. There was one red one in there, but still, 7 quarters of gaining momentum. That's enormous. And the market ran up to record levels that we hadn't seen in decades. So naturally, people got excited, really excited, like overly excited. And that's actually where the problem starts. Because right now we're sitting in what looks like a shooting star candle on that quarterly chart. And if you're not familiar with that term, basically it means the market blasted higher, got rejected hard, and closed near the lows of that candle. It's a classic sign of exhaustion. Too much was happening too fast. And now we're getting a red candle for this current quarter. Now June is the last month of Q2, so we still have time to see where this ends up. But right now, the chart is telling a very specific story, and that story is pullback. And here's what's kind of funny, or not funny depending on how you look at it. There are a lot of angry silver investors right now, like really upset, because in their mind, silver should only go up. Pullbacks aren't allowed, right? Every dip is manipulation. Every red candle is a conspiracy. And I get it. I genuinely do. When you're holding something you believe in and it drops, it's painful. But here's the thing. This pullback, this is actually totally natural. This is how markets work. Momentum runs don't go straight up forever. They digest, they rest. And smart money doesn't panic when that happens. They expected it. So the real question is, how deep does this pullback go? And the honest answer is, it depends on what happens in the broader market. If we get a significant AI market collapse, and we'll talk about that in a minute because it's a real concern, we could see silver pull back all the way down to around $40. That's the first major interim support level. That's where you'd expect the market to find its footing and potentially bounce. On the other hand, if the broader market deflates more slowly, more gradually, then silver could base a lot sooner and at higher levels than that. But either way, the bigger picture call. Once this corrective period is over, we're looking at a target of $333 for silver. Yes, $333. That's the long-term target based on the technical analysis. That's not a typo, that's not hype. That's where the math points. Now, I know that sounds wild. And honestly, when I first heard it, I kind of blinked and had to think about it for a second. But when you understand the framework behind it, and we're going to get into that, it actually makes a lot of sense. The key thing to understand is that these aren't just random price targets pulled out of thin air. They're based on interim levels, on how markets historically behave after extended momentum runs, on where the big money is positioning. And the interim targets along the way have already been hit. We saw the first one, we saw the second one around the 95 to 103 level, which is where, by the way, smart positioning would have had you getting out of leveraged long trades, not because the bull market is over, but because you're at a rest point. You keep your physical metal, your bullion, but you stop trading aggressively long until the market tells you it's ready to move again. This is actually one of the most important lessons in all of investing, and almost nobody talks about it. Momentum investors, people who just chase whatever's going up, they confuse acceleration for inevitability. They think because silver went up 6 quarters in a row, it'll go up forever. And that's exactly how you give back years of gains in a few months. The market can be completely structurally bullish, meaning the long-term direction is still up, while still demanding a painful reset after a euphoric run. The shooting star formation we're seeing isn't necessarily a crash signal. It's more like the market saying, okay, settle down, too many people arrived at the party too fast. We need to thin the crowd before we go higher. Now let's zoom out even further, because this doesn't exist in a vacuum. What's happening with silver is connected to something much bigger, and that something is the potential for what some analysts are calling an AI bust. And look, I'm not saying AI is going away. That's not the argument. The argument is that there's been an enormous amount of capital, like truly staggering amounts of money, that has flooded into AI-related companies and technologies. And historically, when that much money rushes into any sector that fast, you get a bubble, and bubbles eventually pop, or at least deflate significantly. Here's why that matters for silver, for gold, for everything really. If we get a serious AI market correction, and I mean a real one, not just a 10% dip, then in the short term, almost everything gets sold. And I mean everything. Gold, silver, crypto, they all get hit. Why? Because when there's a liquidity crisis, people need cash. They sell whatever they can. It's not about what's fundamentally good or bad, it's about desperation for liquidity. We actually saw hints of this already, with gold and silver pulling back at the same time as crypto was selling off. That's a liquidity chase signal. When uncorrelated assets all drop together, it's usually not about those assets. It's about the need for cash. But here's where it gets really interesting. Once that liquidity panic bottoms, once people have sold what they needed to sell and the dust starts settling, that's when the dynamic shifts. Because at that point, people are going to be looking for somewhere to put their money. And the usual answer of just buy bonds is, well, it's not going to cut it anymore. And this is something really important that I want to spend some time on, because it fundamentally changes how you should think about protecting your wealth. For decades, the investment advice was simple: 60% stocks, 40% bonds. Market goes down, bonds go up, it balances out. But that model is essentially broken now. We've been in a rising rate environment, and long duration bonds, the kind that were supposed to protect you, have been absolutely crushed. An ETF like TLT, which tracks long-term US government bonds, was actually called as a short position back in late 2020. And if you got short then and held until 2022, you made a fortune, because bonds collapsed. And since then, they've been kind of drifting sideways to lower, but the bigger move, the resumption of that downtrend, is likely still coming. Here's the uncomfortable truth. Government debt is no longer the safe haven it used to be. It used to be that when things got scary, you ran to bonds and you were protected. But the math doesn't work anymore. When you factor in actual purchasing power, meaning what your money can actually buy, long-term bondholders have been getting quietly destroyed for years. They're not losing money on paper necessarily, but in real terms, they're falling behind. And most people don't notice until it's too late, because the erosion is slow and steady. So if bonds aren't the answer, what is? And this is where precious metals come back into the picture. Not as a get-rich-quick scheme, not as something you buy because YouTube told you to, but as a genuine capital preservation tool. Gold and silver historically have been the things people run to when the financial system goes through a major stress event. And we're building toward one of those events. Now, let's talk about currencies for a minute, because this is something that most people completely ignore, and it's actually really important. When we talk about silver hitting $333, we need to think about what that means in the context of the dollar's purchasing power. Because if the dollar loses 30, 40, 50% of its value over the next decade, which isn't crazy, it's happened before, then a $333 silver price isn't as outrageous as it sounds. It might just be reflecting how much weaker the dollar has become rather than how much stronger silver has gotten in real terms. There's actually a scenario where the dollar could face what's being called a massive loss in valuation, and here's how that sequence might play out. First, the AI bust hits. In the initial panic, the dollar actually gets stronger. It's a crisis currency. People run to it. Lots of other currencies get crushed. We might even see gold and silver dip further in that moment. But then, and this is the key, once that panic bottoms, once the dust settles, the question becomes, how do governments and central banks respond? And the answer, based on what they've done every single time in the past, is they print money. They reflate. They try to inflate their way out of the debt problem. And that's when the dollar weakens significantly. And that's when the precious metals bull market resumes in force. And that's when you're looking at $333 silver and also a single-digit gold to silver ratio, which would represent the absolute peak of silver's relative performance versus gold. That gold to silver ratio thing is worth thinking about. Right now, the ratio is elevated. Gold is worth a lot more ounces of silver. Historically, in peak commodity bull markets, that ratio compresses dramatically. Silver outperforms gold in the final stages of a bull run. A single-digit ratio would mean silver has massively closed the gap. That's an extraordinary scenario, but it's happened before, and the conditions that create it, debt expansion, currency devaluation, loss of confidence in financial assets, those conditions are building. Speaking of currencies, there's something really fascinating happening in a smaller market that most Western investors aren't paying attention to at all, and that's Korea. Now, why Korea? Because smaller markets often show stress before the bigger ones do. Think about it. Big markets like the US have more tools at their disposal to hide financial pressure for longer. There's more liquidity, more narrative management, more ways to paper over cracks. But a smaller market, the cracks show faster. And what's happening in Korea is kind of alarming if you know how to read it. There's been significant retail investor participation, regular people, not institutions, taking on leverage to keep markets elevated. And the concern is that retail investors don't have the staying power of professional money. When professionals pull out of a market, retail often rushes in to fill the gap, but they can't sustain it the same way. So you might start to see new lows in markets like Korea before you see them in the US. And that serves as a kind of early warning signal, a heads up that the bigger move is coming. If the Korean won faces a significant devaluation, and we're talking potentially around 50% against the dollar in a stress scenario, that would be enormously inflationary for Korean consumers. Their import costs explode. Jobs get harder to find. Loans become more expensive or harder to get. Interest rates spike. Sound familiar? It's basically what happened during the 1997 Asian crisis, and many analysts think those conditions can repeat for smaller, more vulnerable economies before the same pressures eventually hit larger ones. And here's where it all comes together, Because what's really being described here isn't just a Korea problem or a silver problem or even a US debt problem. It's a systemic problem with the entire fiat currency debt-based financial system. Since the early 1970s, when the US closed the gold window, basically saying we're not going to back our dollars with gold anymore, the world has been running on what's essentially a trust-based system. Trust that the dollar holds its value. Trust that government bonds are safe. Trust that the debt can always be rolled over and managed. And that trust has been eroding, slowly, and then, as the saying goes, all at once. Because here's the pattern we keep seeing throughout history. Nations run up too much debt. They can't honestly pay it back, so they devalue the currency instead. It's a form of default, just a sneaky one. The debt stays the same nominally, but the money you're paying it back in is worth less. Creditors get quietly robbed, savers get quietly impoverished, and asset owners, people who own real things, companies, property, commodities, precious metals, they tend to hold their purchasing power or even increase it in nominal terms. This is the essence of stagflation, and it's something we experienced in the 1970s in a big way. Inflation runs hot, economic growth stagnates, living standards fall for ordinary people, even as stock markets might appear to rise in nominal terms. The tricky part is that when you measure things in a weakening currency, everything looks like it's going up. But if you measure your wealth in something more stable, like gold, you might find you're actually falling behind. That's why the unit of account matters so much. If gold is going up strongly while the dollar drifts weaker, gold is telling you something that the dollar-denominated charts might not be showing you clearly. And oil has played a fascinating role in all of this. Oil has been a manipulated geopolitical and economic tool throughout modern history, from the OPEC embargoes of the 70s to the collapse to negative prices in 2020 to where we are now. There was a call for single-digit oil prices at a time when literally everyone was talking about peak oil and prices going higher forever. That's the key signal. When everyone agrees on something in markets, you should get very, very suspicious. Consensus is rarely where the money is made. The money is made in the contrarian call that turns out to be right. So where does all of this leave us? Well, let me try to summarize this in a way that actually means something practically for you. In the short term, and we're talking the next few months potentially, we could see more turbulence. Silver may pull back further. Gold might also see some pressure. Markets could get volatile, especially if AI stocks start seriously cracking. Cash and the dollar might actually look like the smart play temporarily during a liquidity panic. But the medium to long term, the thesis is that we are in the early to middle stages of a major commodity supercycle, that precious metals are going to resume their bull market once the corrective phase is done. That silver, in particular, has an extraordinary long-term target of $333, that the gold-to-silver ratio will compress dramatically, meaning silver will outperform gold. That long-duration bonds are not the safe haven they used to be and could face another significant leg down, and that the currency system itself, the fiat debt-based system we've all been operating in since the 1970s, is under increasing pressure that is building towards something more significant. Now, what do you do with all this information? Honestly, the most important thing is to understand what you own and why you own it. If you're holding silver or gold, you need to be comfortable with the volatility. These markets can have corrections of 40, 50% and still be in a structural bull market. If you're not prepared for that emotionally and financially, leverage is not your friend. Physical bullion meaning actual coins and bars that you hold, is a very different risk profile than leveraged paper positions. You can ride out volatility with physical holdings in a way you simply can't with leveraged trades. If you're looking at the broader picture, currencies, bonds, equities, the framework being laid out here suggests that any allocation that depends entirely on long-duration government bonds for protection is potentially sitting on a hidden risk that most people don't appreciate. Diversification into real assets, into precious metals, into things that hold purchasing power through currency devaluation cycles. That's the kind of thinking that protects wealth in the kind of environment that seems to be building. The biggest mistake you can make right now is to confuse nominal gains with real wealth. Your account balance going up doesn't mean your purchasing power is going up. If the dollar is losing value faster than your account is growing, you're actually losing in real terms, even though the numbers look good. That's the illusion that inflation creates. That's how the system quietly impoverishes ordinary people while enriching those who own hard assets and production capacity. And yeah, that's uncomfortable. It's not a fun thing to talk about. It's easier to just look at your account balance and feel good. But understanding what's actually happening, the macro forces, the debt dynamics, the currency pressures, that's what separates people who preserve their wealth through a tough cycle from people who wonder what happened. So take this seriously, not to panic, not to make crazy decisions, but to understand the environment you're operating in and position yourself accordingly. The correction in silver right now isn't the end of the story. According to everything we're looking at, it might just be the intermission before the most interesting chapter begins.